Today, stocks closed the day in free fall, handing in their worst performance in months. Also, Grubhub and Uber break up before they ever made things official. And finally, we dive into the money that fueled stocks higher for weeks. Spoiler alert, it's not the so-called smart money. I'm MacKenzie Sigalos, and this is CNBC After Hours. It was an ugly day on Wall Street, a sea of red across the board as stocks plunged lower throughout the day. These losses are extraordinary. We're in the four figures here. The Dow fell more than 1,800 points today. Its worst day since March 16th. It's all very fast and furious. Stocks have been on a tear lately, rising very high, very quickly. So what happened today? Mainly a mixture of three things. The first, the state of the reopening. We're now seeing upticks in case counts and hospitalizations in states that have reopened. Developments like this remind investors that we're not out of the coronavirus woods yet. The second is the Fed. In his remarks yesterday, Fed Chair Jay Powell signaled that he thinks the recovery is going to take a long time, throwing cold water on hopes of what Wall Street calls a V-shaped recovery, which means that we'd bounce back as sharply and as quickly as we fell, forming a V. And the third we'll call froth. Froth is finance speak for when the price of an asset doesn't match its underlying intrinsic value. In other words, it's bubble-like behavior in the stock market. This goes back to when we said everything was fast and furious. So take something like United Airlines. It shot up 50%. Yes, 50% in 3 trading days. Meanwhile, the fundamentals of the company didn't change. That's froth. And some experts think that frothiness is interwoven into another big stock market story. The reign of the retail investor. Now, retail investors are individuals, not the pros. And it's these individuals who enjoyed most of the gains on the way up this spring, while many pros, often dubbed the smart money, missed out because they were cautious. Some market experts think the influx of retail investors contributed to the market's frothy state, leading to days like today. And that may be true, because we know for sure that a ton more people opened brokerage accounts on apps like Robinhood and E-Trade during the pandemic. CNBC reporter Kate Rooney dug into those numbers for us.
The pandemic has been a boost for financial technology for a few reasons. With shelter-in-place, people often have no choice but to bank and to pay on their phones, and people are logging more time on finance mobile apps. In the first quarter, average weekly time spent on finance apps grew 55%. That's according to a report from App Annie. Total time spent monitoring the stock market on trading apps like Robinhood grew 80%, according to that study. Venture capital investors are also jumping on the mobile finance trend. We've seen a handful of late-stage fintech deals in recent weeks. In May, Robinhood announced a new round of funding at an $8.3 billion valuation. The trading startup has seen record new accounts open in the first quarter, along with other brokerage firms. We had Fidelity and Charles Schwab, for example, also recording record new accounts in that quarter. 2020 has seen this boom in retail investors. Part of it, analysts say, is commissions going to zero. So Robinhood kicked off that trend. There are now pretty much no commissions at all of the major brokerage firms. You also have fractional trading. So instead of buying an entire share of Amazon, you can buy $1 worth. In some cases, it's a $5 minimum at Charles Schwab. So that has really lowered the barrier to entry. Others are saying that younger traders are using this moment to get into the stock market. They haven't been investors in the past, and they're using apps like Robinhood and taking to social media and places like Reddit to talk about stocks in a way that they probably didn't otherwise. You have folks like Dave Portnoy, the CEO of Barstool, who has been on CNBC a few times, talking about the similarities between gambling and trading stocks, and that because live sports are not available because of the pandemic, he's turned to day trading for sort of that rush of adrenaline instead.
And I love this game. You know, whenever I'm on this show, all the critics like, why you have this guy on? He doesn't know what he's talking about. He's a moron. Well, I made $1 million today, so now I'm the smartest guy in the room. So I'm having fun.
So it'll be interesting to see if that retail trend continues once shelter-in-place lifts. People are back at work. They don't have as much time to look at the markets. And we'll keep an eye on it and see if this trend continues through the end of 2020.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves today.
Remember that we entered this week up 40% or more from the March 23rd low in the market. And that narrative, that optimistic narrative was based on a reopening economy, some good news in vaccines. But within that rebound was in stock prices, there was always these seeds of doubt that there could be, yes, another second wave of coronavirus, doubt that it would be harder to restart this economy than it was to shut it down, and doubt that the recovery could be more protracted than was currently priced into the market. And that's what you're seeing today.
Well, look, I think we should be concerned, but when you look at states like Arizona and Texas, South Carolina, North Carolina, those are where the big outbreaks are right now. Florida, to some degree, seems to be going up. It's not a second wave. They never really got rid of the first wave.
We can't shut down the economy again. I think we've learned that if you shut down the economy, you're going to create more damage, and not just economic damage, but there are other areas, and we've talked about this, of medical problems and everything else that get put on hold. I think it was very prudent what the president did, but I think we've learned a lot.
The board had a very easy decision to make. Regardless of our options, we went with a much higher offer with much more deal certainty that brought us significantly more, or I should say significant financial strength and flexibility to continue doing what we're doing now.
We've always said Discover is a closed platform, and we choose the types of content we want to promote on our platform. So we're well within our First Amendment rights to decide what shows up on there. And, in terms of our business and our community, we're very focused on our values and expressing our values through the things that we promote on Snapchat. So I think it was a relatively easy and straightforward decision, and we'll continue to try to create a Discover experience that reflects our values and promotes the types of content that we think are important for our community to see.
In the last 24 hours, two of the biggest tech companies in the country took a stand regarding one of today's most controversial technologies, facial recognition. Amazon and Microsoft aren't the first to slow the use of their facial recognition software. IBM left the business entirely earlier this week. But here's the thing. While American lawmakers debate the ethics of facial recognition tech, the pause could have implications for the software's longer-term development. All the while, Chinese companies are moving full steam ahead. CNBC's Deirdre Bosa can break down all the details.
So facial recognition has been one of the most divisive issues in big tech, with all the big players sort of taking different stances against it. In the past, Google has said that they would not be selling their technology for commercial use at all. So a few days ago, when IBM joined in and said that they would no longer sell their facial recognition technology or software commercially, that was a little bit of a surprise. They went a step further and they called on Congress to actually think about this topic and start to regulate it. A few days later, when Amazon said that it would put a moratorium for 1 year on selling its facial recognition technology, it's called Recognition, to police officials, to police agencies, that was a big surprise. Typically, Amazon has said that they would not do something like this. Andy Jassy, about a year ago, in an interview, said that they were open to selling the technology to any federal agency, and that has certainly caused a lot of waves with lawmakers and civil rights activists, because facial recognition technology is an extremely controversial one. It's thought that if it's put in the hands of the wrong people, it can be used for things like racial profiling and discrimination and a surveillance state. When you look at something like facial recognition, when you open your phone, that's an important technology. It's going to lead to more ways of doing business, to less friction. And it's a technological development that we don't yet know the full use cases. Similar in the way that 5G, China was very much ahead in developing 5G, a new technology, and the US has fallen so far behind. It has become one of the most important next generation technologies in the world now, and the US is woefully behind, doesn't even have a company that can compete with a Huawei or some of the European ones. So it's critical, but it's also extremely controversial. So when you see a country like China that doesn't have the same privacy concerns among its citizens, there's likely to be a divide going forward.
Okay, now for today's numbers round. Let's kick it off with 0.67. European food company JustEatTakeaway.com will merge with Grubhub. The price? 0.67 Just Eat takeaway shares per Grubhub share. Now, when the deal was announced last night, this offer was worth about $7.3 billion, but shares have moved since then, so the total value has changed a bit. But it's still a several billion-dollar deal. So why does this matter? Well, investors always care about mergers, but this one is particularly interesting because up until the last minute, everyone thought that Uber was going to buy Grubhub. The two companies have been in talks for a few weeks now, but at the 11th hour, Grubhub spurned Uber and paired up with Just Eat Takeaway instead. Next, zero. The Federal Reserve said yesterday that they're keeping interest rates near zero. Something like this happens 8 times every year. The central bank gets together and makes a decision on interest rates. But something happened yesterday that doesn't always happen. The Fed said it sees rates staying near zero all the way through 2022. A low-rate environment makes it easier for companies to borrow money because interest payments on the debt would be relatively low. And it affects individuals too. People like me and you. We can borrow money at lower rates, which makes things like buying a house more accessible. Easier access to borrowed funds keeps money flowing through the economy. And the thought is that this would essentially avoid a sharper downturn, with corporations and households holding onto all of their cash. And finally, one. Under Armour sold out of its new athletic performance face mask in under 1 hour. Today, the company released the, quote, first of its kind mask, but by the time a CNBC reporter tried to look for it on the website, it was gone. The Under Armour CEO responded to our reporter's tweet saying the masks had sold out, but more would be available in July. That's it for After Hours, but before we go, here's one more thing to keep an eye on. This Monday, the CEO of Tesla competitor Nikola Corporation will be on CNBC at 5 p.m. Eastern. You're going to want to check out this interview. Nikola's stock doubled last week. One important note, this company has no revenues at all. Get the latest on Nikola stock by going to CNBC.com and downloading the CNBC app. We'll be right here in our home office every Tuesday and Thursday with a new edition of After Hours, so be sure to catch us then.